Today we're diving headfirst into the beautiful, complicated, and currently rather stressed-out nation of Romania. Imagine an economic roller coaster, one that's been climbing impressively for a while. Now, picture it hitting a rather bumpy, unexpected dip. That's Romania for you right now. After a period of what looked like solid progress, the country's economy decided to pump the brakes hard in 2024, and 2025 isn't exactly shaping up to be a smooth ride either. We're talking about a significant slowdown, the kind that makes economists use words like concerning and challenging, which, in economist speak, is basically a polite scream. This is going to be quite the economic exploration. Let's talk GDP, or gross domestic product. It's the big number everyone watches. For Romania, that number has been a bit of a disappointment lately. Real GDP growth slowed down dramatically to just 1.4% in 2024. To put that in perspective, it was the slowest pace since the charming days of the COVID-19 pandemic. Yes, that's the benchmark now. And if you thought 2024 was sluggish, the first quarter of 2025 offered little cheer, with GDP growing only 0.2% year-on-year. That was significantly below the already modest forecast of 1.2%. So what put the brakes on Romania's economic engine? Several culprits are lined up. Firstly, external demand went a bit shy, especially from Romania's key trading partners. When your neighbors aren't buying as much, your factories don't produce as much. Speaking of which, industrial production itself saw a decline. Add to that a slump in residential construction, fewer new homes being built is a clear sign of economic caution. Net exports, which is the fancy term for the difference between what a country sells abroad and what it buys, actually dragged GDP down in 2024. It seems Romania's economic competitiveness on the global stage took a bit of a knock. Let's move on to inflation, that sneaky thief that makes your money worth less. In Romania, inflationary pressures have been as persistent as a telemarketer during dinner. While there have been some signs of moderation, it's still a major headache. The annual inflation rate actually ticked up to 3% in December 2024, a slight increase from 2.8% the previous month. What's driving these price hikes? Well, it's the usual suspects: higher prices for food and non-alcoholic beverages, furnishings and household equipment, and transport. On the slightly brighter side, the pace of inflation did slow down for some categories like housing and utilities, health and communication. The real issue is that underlying price pressures remain elevated. This is largely due to strong domestic demand and significant wage growth. The National Bank of Romania has a target to bring inflation down to its comfort zone of 2.5% plus or minus 1 percentage point, but they don't expect to hit that until late 2026. Now let's look at the labor market, which has shown surprising resilience amidst this economic slowdown. The seasonally adjusted unemployment rate actually dropped to a 5-month low of 5.3% in November 2024, down from 5.4% the previous month. This reflects pretty strong labor demand. Businesses are still looking to hire. Section 4, the Central Bank's Balancing Act, taming inflation without tanking growth. When the economy gets wobbly, all eyes turn to the central bank. In Romania, that's the National Bank of Romania, or NBR. Their main tool for this delicate operation is the benchmark interest rate. Think of it as the main volume knob for the cost of borrowing money in the economy. The NBR has kept this rate steady at 6.5% since August 2024. This came after some earlier rate cuts in the year, suggesting they initially thought they could ease up, but then conditions changed. So why did the NBR hit the pause button on lowering interest rates? Well, several factors forced their hand. Firstly, inflation started creeping up again, partly due to higher fuel prices globally and a stronger US dollar, which makes imports more expensive. Secondly, there are serious concerns over fiscal imbalances. That's the government spending more than it earns. And thirdly, capital outflows became a problem. That means money was leaving the country, which can destabilize the currency and the broader economy. Section 5, Red Ink Rising, Romania's Fiscal Cliffhanger and Debt Dilemma. Alright, let's talk about the government's finances, or what economists call the fiscal position. And in Romania's case, this position has deteriorated significantly. The general government deficit, the gap between what the government spends and what it takes in, was projected to hit a whopping 8% of GDP in 2024. That's a big jump from 6.5% in 2023. Some reports even whispered fears of the deficit exceeding 9% of GDP, which is the kind of number that makes credit rating agencies sit up and pay very close attention, and not in a good way. What's fueling this gusher of red ink? It's a combination of factors. On one hand, government spending has grown rapidly. We're talking substantial increases in public sector wages, a popular move politically but expensive. Social transfers like pensions and benefits have also increased, and public investment, while often necessary, adds to the spending column. On the other hand, revenue growth has been a bit sluggish, not quite keeping up with the spending spree. This is partly due to the weaker than expected economic activity we discussed earlier. When the economy slows, tax revenues tend to dip. Section 6. Political quakes and market shakes, the high cost of instability. Now you can't talk about Romania's economic woes without addressing the elephant in the room, political instability. It's like trying to build a house of cards during an earthquake. Not very effective. The political situation, particularly following the tumultuous 2024 elections, has significantly exacerbated the existing economic challenges. The strong performance of far-right Eurosceptic nationalist figures, notably George Simion, in the repeat presidential election sent shockwaves through the system. This led to the rather dramatic collapse of the pro-Western governing coalition, creating a power vacuum and a whole lot of uncertainty. The market reaction to this political turmoil was swift and brutal. We saw significant capital outflows, meaning investors got nervous and pulled their money out of Romania. Section 7. Charting a course through the storm solutions and Romania's road ahead. So here we are, May 2025, and Romania finds itself grappling with a rather complex and interconnected set of economic challenges. We've seen how slowed GDP growth, persistent inflation, high interest rates, a ballooning public debt, and unsettling political instability have combined to create a potent cocktail of concern. It's not an enviable position, to be sure. Certain sectors of the economy are showing some resilience, and there's a baseline expectation of modest recovery, but the path forward is undeniably fraught with obstacles. The current situation is a clear signal that business as usual is not an option. What then can be done? Well, there are no magic wands, unfortunately. Addressing the structural fiscal imbalances is paramount. This means making some tough choices about government spending and revenue collection. The commitment to reduce the budget deficit is a good start, but it needs to be backed by credible, concrete, and often politically difficult measures. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.